Welcome to your weekly market update. Well, the election is over. Donald Trump will be our president again. Amazing race ran by him. Amazing race ran by Kamala to be able to do what she did with 90 days of work, and for it to be that close is just impressive. So no matter who your candidate is, we just pray that everybody comes together. This is impacting the markets, however, and they've continue to be extremely volatile. Now, remember, there's now four main markets that are competing over investment dollars. You have the stock market, you have the bond market. Mortgage rates are a function of the bond market. You have the crypto markets, and you have treasuries, right? So these are all the different markets that are competing over the same investment dollars. And right now, with the Trump victory, the stock market has ran way up. Cryptos have ran way up. So you're seeing what's called a flight to risk trade. That means money coming out of safe haven investments and going into the stock and crypto markets. Well, that comes at the jeopardy of the bond market. So you can see we've correctly locked here, and we correctly locked back there to avoid this big interest rate increase. So remember on this chart, the lower it is, the higher the mortgage rate. So yes, mortgage rates have gone up by over 1% in the last 3 weeks. We protected all of our clients that were working with us and correctly called this. We will now remain floating because tomorrow is the Fed's meeting today, and their announcement will be tomorrow. Everyone's expecting them to cut another 0.25%. I believe last Friday's jobs report that came in very weak. You know my thoughts on the job report. It was just further revisions. It looked like the private sector, the report I trust more, ADP, that came in positive. So it looks like there's resilience in the job market if you follow the ADP report. If you follow the government's Bureau of Labor and Statistics, it's all over the place. So it's hard to tell without accurate data. So I look at the ADP report, you're seeing some strength in the jobs numbers. So that all being said, remember these markets all compete over these dollars. We believe this line will hold, right? If you see this line, it's hit there a couple of times. We believe there will be a bounce off. If you look at 15 out of the last 16 times the Fed has cut interest rates, within 2 months, mortgage rates have gotten better. So there's an initial knee-jerk reaction, right? But right back here, and rates got better, right? And then they go up. And why this happens is because people are pulling their money out of their savings accounts, where some people were getting 4 or 5% on, and they're locking it in on treasuries, right? A 10-year treasury, they were locking in a 4.25% return. So they're locking in around the same return. And if you think about this logically, the savings account interest rates you're being paid are going to go down as the Fed cuts those rates, right? And they can lock in for 10 years with that money on a 10-year treasury, which isn't guaranteed, but all but guaranteed unless the US government goes away. So that's why they're doing this. That's why this is happening. Mortgage bonds, which competes with those treasury bonds, has to increase their yields, their interest rates that they pay in order to attract those investors, right? So they're all fighting over this money. A Trump win means a stronger stock market. At least that's how Wall Street reacted yesterday. And he had a pretty good history until COVID. So that's why that reacted that way. The crypto markets look at Trump as being more crypto friendly and the Republicans to be less regulation heavy. Whether you think that's good or bad, that's how they view it. And that's why those markets were rallied. So we might have a little bit of a wait for mortgage rates to come down. We're still confident that they will. We believe that inflation is already under control, and the Fed's done a great job. For the most part, they waited too long and to get aggressive, just like they waited too long for the rates to be too low. So they do wait too long, but they did take extreme measures to kind of get this under control. So we're looking at the economy in a great place. Fannie Mae, Freddie Mac just came out and said next year that they're expecting production to almost double. So what does that mean to you? That means higher home prices at the lower interest rate. So now is the time to be aggressive. I'm working diligently myself on trying to buy more properties to develop. I have an investment that is a development company. Don't worry, I don't spend much time there. I'm always working on loans, but I have an architect in GC that builds properties for me that we sell. And we are working very hard to not wait until the spring because we know prices are going to skyrocket up in the spring. At least that's what we think because the rates will be lower. And there's all this pent up demand because so many people went on the sidelines to wait to see how this election played out. So sorry for the longer video. Just wanted to give you an update what's going on. We believe the Fed will cut a quarter tomorrow. That's kind of already been priced in. So we believe we'll rally up a little bit. This line, I believe, will get kind of up to there. If they do a half, we're going to rally even bigger. If they do nothing, we might lose this line. So we will be watching this, but it's pretty much a guarantee they're going to cut a quarter after the last job report. So thank you. Be aggressive. Send us a property if you need us to run numbers at these now higher interest rates. Remember, we'll refinance for free. And remember, we allow you to pay points now to get a lower interest rate. And we see some buyers negotiating a rate buy down. And we will also carry those points over if you pay them to the refinance. So you get the benefit now, you get the tax savings if you can close by the end of the year on your tax returns just already by April 15th. And you get the lower interest rate when you refinance. So we will do that for you because of the higher interest rates. If you'd like us to run any numbers on that, give us a call or drop us an email.